straight on over to Bruno Simao, our resident boffin. When was the last time we actually heard that word? Our resident property boffin. This man knows everything and anything you need to know about property. Like, he's your go-to guy. And so, Bruno, whenever you're ready, by all means, please, you can take over from me.
Thank you so much, Kali. Let me share my screen for everyone to see. Great. Here we go. Great. Thanks so much, guys, for having me on. It's always such a pleasure. Today's topic is quite interesting, especially with the sourcing and certain issues that have related to sourcing over the last few years. So as usual, we're going to give you a property tax update and a property law update. And to do the property tax update, my business partner, apologies, my business partner, Shiliboy Mutiba, is joining me. For those that don't know who I am and don't know who my business partner is, my name is Bruno. I'm a specialist property attorney from Bruno Simao Attorneys. I'm also the co-founder of Intergen with Shiliboy, and that focuses on wealth preservation management and that sort of thing. And together, basically, we try and service property investors to the greatest extent by dealing with their disputes, their commercial work, and their tax problems. Shiliboy, do you want to introduce yourself?
Yeah, thanks, man. My name is Shiliboy. Good evening, guys. My name is Shiliboy Mutiba. I'm a CA by profession. As Bruno said, I'm a co-founder and a director at Intergen, where we specialize in wealth advisory. Thank you.
Cool, guys. So I'll start first. I'm going to deal with the legal side of things, and we're looking at sourcing. Now, there's a couple of do's and don'ts that I want to run everyone by so that you guys understand the nature of sourcing. So obviously, Leon is going to speak tonight, and he's going to explain the complexities and the best ways of doing it, the strategies and that sort of thing. But from a legal perspective, we do need to look at consider compliance. So first things first, big warning is compliance, right? What does sourcing actually mean? And the problem is that the word sourcing is used very loosely, and a lot of property investors don't understand its true meaning. Sourcing a property and passing it on to somebody else is the equivalent of brokering. It's pretty much what estate agents do on a day-to-day basis. They broker a deal. They take a seller, they take a property, they take a purchaser, and they connect all of them. Just because some of us source deals to other investors, the reality is they are still, to a certain degree, buying the property. So unless the property is not being sold, and these investors, for example, are simply going to some kind of JV with the owner of the property, as long as there's a sale agreement, that constitutes brokering. And if that is what your definition of sourcing is, you've got a bit of a problem. Unfortunately, the Estate Agency Affairs Act at the moment, but very soon the Property Practitioners Act, govern how property brokering is supposed to take place. And there's a lot of guys out there that tend to ignore this, that have opted to try to argue that there's some kind of loophole around it. The problem is there isn't. To broker a deal between a seller and a purchaser, one has to be registered as an estate agent. So this is a big warning. So very quick one. If you're not registered as an estate agent under the current act, you're not allowed to charge for commission. Fortunately, if you did charge for commission, no one can claim it back from you. But under the Property Practitioners Act, different story. Property Practitioners Act, if you get paid a commission, they may claim it back from you. So be very, very careful with that. So now that's the don'ts. So let's find solutions to these problems. That's my job. So solution, what do? Number one, simple, clear-cut solution. Register as an intern estate agent or a candidate property practitioner. Speak to Leon, speak to Nico. The property brokerage is actually taking on people, guys that want to be registered as agents. We take them on under our wing, we help them out. So consider that, but it doesn't have to be us, any estate agent. But if you do want to broker deals properly or source deals and pass them on to somebody else for a commission, ideally register, make it legal. It doesn't actually cost that much money. Yes, it takes a bit of effort because you need to study a couple of things and write a couple of exams, but you guys have come this far, do it. And like I said, since we focus on investments, we're actually looking for people to come to us that we can actually train and work through our ranks. So yeah, that's number one solution, register. Seems pretty simple, takes a bit of effort. Number two solution. This is an alternative to sourcing, which is called information sourcing. Now, it's a very, very tricky way, and I've done this for a couple of clients, but some guys really don't get into the brokering side of things. They might approach a seller, might chat to him, get a bit of information from him, and literally just pass on information to somebody else. This is not brokering. I won't lie to you, there's no case law that says it is or isn't. So this is basically me making an assumption here. So please don't hold me to it. Until it's tested, I cannot advise you legally on it. But I would wager a guess that if you're simply passing information on and you're not brokering the deal, you're not going in there trying to connect the parties, making sure everything goes ahead, OTPs are signed and all the rest, and you're simply passing on a piece of information, this could very well work. So guys, it is an alternative, and I've done it with a couple of guys successfully. So it is something you might want to consider, and you pay for the information you're passing as opposed to a service of providing a brokering service. Now you can see that there's a fine line here, and it's a bit of a gray area. So it's very easy to cross that line. So guys, be very, very careful with that. The other alternative is on selling and back-to-back strategy. Now, a lot of you have received education in this regard. I'm not going to speak about it at length, but I do kind of want to touch on the fact that if you on-sell a property or do a back-to-back, what does that mean? You buy a property, submit an OTP, you become purchaser number one, you find purchaser number two, and you give it to them without you ever taking transfer. So the transfer through the deeds office takes place simultaneously. So from seller to purchaser one to purchaser two, all on the same day at the deeds office. And the benefit to this is that you don't have to run through two transfer processes. It's very, very quick. And depending on the conveyances that you're using, you might be able to use the money from your purchaser to fund your sale. So that guarantee gets released and effectively gets released to the seller. A portion of it gets released to the seller to cover the main purchase price. You get your profits, and you never actually have to pay the purchase price or apply for a loan, which comes with its own costs. So this is a really, really cool strategy, not guaranteed to work all the time. Some conveyancers don't know how to do it, and some conveyancers might have issues doing it. And some banks that sell properties also raise issue with this because they don't want to rely on a second transaction to get their money. Because if there's an issue with the second one, the first one doesn't go through. So some of the properties that are sold directly by the bank. So you look at your repossessed properties, even in some sales and execution, they don't like linking the transactions or using the same guarantee. So there are certainly some limitations, but it works for the most part. Then the last one is the sale of shares, right? Now, be very, very careful with this, because remember, the issue with SARS is that SARS does not want you to buy a property and give it to somebody else without you paying transfer duty for your transfer. That's why the on sale is legitimate, because you pay transfer duty twice, right? The problem here, and one of the reasons why SARS did away with the concept of nomination or assignment, as the Americans call it, is the fact that they wanted double transfer duty. So unless you assign the contract to somebody else by midnight of the same day, SARS would consider it as two transfers and would require you to pay twice. So with some transactions, but be very careful, because this is going to be an issue. But we've managed to do it by selling shares. Now, it's a bit complicated, but it could be done if you buy the property in a company name. We actually do a transfer of shares at the right time to be able to pass it on to somebody else, and the purchase price is effectively equivalent to the sourcing fee. But I'd be very, very, very careful with this one, guys. It hasn't been tested. It's something relatively novel, and SARS is not going to like it, which is why we try to steer clear from it in order to actually stay off SARS's radar when it comes to things like this. Now it is Shilly Boy's turn. Yeah, it's all yours.
Thank you so much, Bruno. And like you said, tonight's topic is about flipping and deal sourcing. And there's also, again, when it comes to tax, where there's a gray area between whether if I'm doing a flipping, whether I'm going to be taxed in that particular income, whether in a capital gain tax or in revenue in nature. But before we dwell into that, I think let's take a step back and say, what is capital gain tax? A capital gain tax, particularly, it happens when you dispose what we call an income generating assets, where you have held a property for some time and you held it in a form of capital in nature. Now, with that, the difference between having held the property in capital in nature or revenue in nature depends on your intention. Now, it's going to be your responsibility to prove to SARS whether you held the property as a revenue or as a capital in nature. When you buy or when you want to flip that property, you need to ask yourself, what is your intention? If, for instance, you're going to buy a property and before you even finish refurbishing it, already you've hired an estate agent to put it on the market for you and you turn it around within 6 months to 9 months, that can be considered as revenue in nature. I've seen scenarios where people tend to do a flip in one flip in a company, and then they declare that as sort of having disposed capital assets. Having said that, it's a gray area. You need to be very, very careful, because if it happens that you repeat a similar strategy quite frequently, SARS might pick it up and say, listen, your original intention here is actually trading in properties. As a result, you need to be taxed when it comes in revenue in nature. Reason being that you're frequently doing this trading. Well, as compared to income generating properties, you'll be taxed when you dispose those properties on capital in nature, because you held them for quite some time. I mean, normally you might hold your properties for more than 3 years. And that, as a result, when you dispose that particular property, you'll be taxed as capital gain tax in principle. So the distinguish factor here is your intention as a property investor, which you need to be very, very careful. Now, with that said, in most cases, why people will want to push to be seen as having done or disposed in capital in nature, mainly because when you are taxed from under capital gain tax, you actually pay less tax as compared to when you will be paying that income under revenue in nature. Typically here, under revenue in nature, you will find that it's developers in most cases. Those guys will go and buy land and develop and dispose those apartments or cluster homes, and they'll typically fall under, they'll be trading under the company where they actually been taxed at 28%, as compared to if they had built that particular units and rented them out and then disposed them maybe after 5 years or 10 years or so, then effectively the capital gain tax will be effectively at about 22.4%. So I've seen scenario where someone says, listen, I'm not actually generating income in my personal capacity. Can I flip a property under my personal name? Because effectively I'll be paying about at most 18%. You might even pay less, especially if you're not any form of income in your personal capacity. You could do that and flip it and be subjected to that 80%. But like I said, if you continue repeating that method and it happens that SARS audits you, it might, because SARS they can go back and actually say, listen, your intention here is actually trading in profit, because you will have to prove to SARS that you are actually not trading in properties, but you are just disposing what you call income generating property. Some might find that actually they've got income generating properties in a trust and they want to flip them. Just be aware that you effectively might end up paying 36% capital gain tax effectively, but Using conduit principle, you might end up even paying less because you can dispose that capital gain tax to the beneficiaries of a trust and then effectively end up benefiting to that individual tax. So with that said, that's pretty much that you need to be careful, especially you guys who are doing flips. Be careful on creating a trend that might end up leading you to be seen as trading in properties and versus to having been trading in capital, because if you don't get your intention right, you might find yourself having to be taxed in revenue in nature. That's it for me from Bruno. I don't know if you've got anything else.
Cool, thanks so much. Yeah, that was great. I think that covered everything. Thanks so much, everyone. If on Concord, we're going to be in the Bruno Simao Attorneys and Intergen room, and you can speak to anyone, Shilly Boy, myself, and Alexa. We've got a team of people there to help you. Thanks.
Okay, fantastic. It's yeah. So it's actually dashboard. Discord. Oh, Discord. I got it wrong too. So I know we actually have an entire discussion on Discord. We also have questions in the Q&A. So I wanted to throw this. So you could either go to Shilly Boy or you, Bruno, because we just got a question right now. It's could you kindly please assist me with information regarding the capital gains tax? When is the seller obliged to pay, I beg your pardon, capital gains tax? And what if the seller is a trust or a company? Can it be waived? So essentially can capital gains tax be waived, and when is the seller obliged to pay it?
I
think this is perfect for Shilly Boy.
Oh, do we answer now? I thought there'll be a Q&A. Okay. No, that's fine. You will be obliged to pay capital gain tax if you make capital gain. If let's say you have disposed that property under your personal name, and you will pay capital gain tax if you made capital gain from disposing that particular property. So with regard to wavering, I'm not sure you can waiver if there's a need to pay capital gain tax on if you made capital, unless the disposal of that property is those ones relating to manufacturing, because if you use proceed from disposed property, you can actually buy similar properties and then replace that, and then you can roll over. It's not actually a waiver, but rather than a rollover. But when it comes to typically residential property investment, you can even roll it over. You just have to pay capital gain tax if you made capital gain.
So maybe just to echo what you're saying, so the reality is, provided that your purchase price or the market value at the time of disposal is higher than what you bought it for, you're going to need to pay it. It accrues at that moment and you pay it immediately. You need to declare it within that tax year. What is interesting, but this again is something very specialized. There are certain contracts a person can enter into that make it contingent, that basically drafted in a particular way. You haven't actually disposed of the property until the happening of a certain event, but that is very, very, very advanced. It's something that we fitted into certain contracts only under certain circumstances. And it's also difficult, the terminology that we use. Is it a deferral? Not really. Is it rolling over? There's even arguments that you pay proportion over a certain period of time until the contract's concluded, and you know for certain that you've got the property. So this used to be drafted around installment sale agreements and could work, but again, it's kind of specialized. It takes like a legal and tax approach to it, but that's pretty much the only way I know of where you can avoid capital gains tax on an actual capital gain.
And with that, I think you will only do that if you also make sure that the installment paid are actually less than the original base cost. In that way, you might actually defer or rather postpone the potential capital gain tax, but eventually it's going to catch up with you at some point.